Hey everybody, it's Pete. Good morning. Welcome to a new episode of Stocks for Breakfast. And today we're going to talk about is the trade of the year and whether or not you caught it and to how to make sure you catch it next time. That's the big thing. It's one thing to see it after the fact, which we're going to do right now, but that's not the point of today's video. Today's video, we want to talk about how it's easier to make money when you first track the market and then track your stocks. Now, everything we trade is obviously stock specific. So we're trading that stock, but I also get the question of what if the market turns? What if the market reverses? What if the market's really strong? How does that affect my stock? And it just goes to say, beyond a shadow of a doubt, it is infinitely easier to find high probability trades, to find trades that have a good expectation of following through and making money if you follow and trade stocks that move with the market. Can you make money with stocks that don't trade with the market? Yes, of course. But why would you want to make things more difficult for yourself? If the market's obvious, you might as well trade stocks that are moving with the market. So we're going to talk specifically about the SPY ETF and the bounce off of the lows in March of 2020, and then how that set up what we call a box, or when it went into the right price. And it was actually after an FOMC announcement in June, and a lot of traders struggled in that window because they were just trading this long only bias, which we had off the lows, which there's nothing wrong with that. But the market itself was kind of in this back and forth price action. It wasn't as obvious. So that translates into different trade management. That translates into different trades going into your game plan because the market wasn't obvious. Now you had to drop down and go sector specific, which is a change, right? So you went from everything is beautiful and everything is moving in one direction to now the market is not as obvious. Or you could have shifted over and said, well, now let me go and find specific industries or specific sectors that are obvious and then only break it down into those stocks. A lot of people ask that, which stocks go into your game plan? And generally speaking, I have a list of the same 20 to 25 stocks that are in my list every day. Doesn't mean I trade them all every day. It means that they meet the criteria that when they're in play, which means they're obvious, and they have a catalyst and moving in a particular direction, only then will I trade those stocks. So if you can imagine 20, let's just say 20 to keep it simple. Let's say we have 20 stocks that meet the criteria. They have volume and volatility on a day in and day out basis. Sometimes those stocks are in play, meaning they're obvious, and sometimes they're not. So the ones that are obvious, those are the ones that I allocate shares to, both as a day trader, a swing trader, and a position trader. But I'm always watching the other ones because I'll start to see some of them float up to the top of the list, and maybe some will float out of the list. Some of them I stop making money in, and then I pull those out of the list, or I just stop trading them, really. But when the market's obvious, usually the whole list gives me opportunity. So I have the universe of stocks, and you pull some stocks out, you put some stocks in. Every once in a while, you run scans. You're like, oh, wow, those stocks are interesting. For example, coming off the pandemic low, I never traded DocuSign before, or Wayfair, or Etsy, or any of those stocks, but they were in play. You know, they get out of the house, and even Zoom, how I'm recording this video right now. So you start to see how some stocks are off your radar, then they get onto the radar, and then you start to trade them a little, which, by the way, that's also a big tip as well. When a new stock goes into your list and it's the first time, you should watch it a little bit before you trade it. You want to see how it trades. I'll give you an example. OSTK is a really good example of that, where if you've never traded it before, especially if you've never day traded it before, it's a stock that could move levels. And when I say levels, it could move 50 cents like that. And for a day trader, that's actually a pretty decent move. We're used to trading stocks that have plenty of liquidity and move orderly. DDOG is another stock like that. You could trade it, but if you're watching it a little bit before you trade it, it's not a shock when you place your first order. You're like, what just happened? I'm down 50 cents on the trade. So we're going to look at the market, the SPY ETF specifically. We're going to walk through what was the trade of the year coming off of the lows and how you can pick up that trade next time. By the way, if you find these videos helpful, absolutely click down and subscribe. That would mean the world to me. And if you want to trade together and learn exactly what I do, click down and learn about the bootcamp too. So we're going to head over and we're going to watch the SPY. And we're specifically going to talk about bouncing off of the lows here in mid-March into April. So one thing you'll notice is that I very rarely have moving averages on my charts, and it's because of what we're about to do. I want to get a feel for the charts, and what I call is I work the charts, and anybody can do this. It's actually very simple, but you need to do it correctly, and even more importantly, you need to interpret it correctly. So we're going to use our simple trend analysis, trend drawing line. So anytime you're drawing trends, you want to start with the lowest low in the window that you're talking about. So we're actually talking about 2020 right now. And you start at the low and then you move it up through the highest low without crossing any price action. So in this case, we are talking about right here. So off the March lows, we bounced. Now we could have drawn a whole bunch of separate ones, but we want to really get into the meat of what I promised, which was the trade of the year. So you can see, actually, we didn't cross any price action. We went through the highest low, and this is where price crossed. Now, a lot of people make the mistake believing that that's a change of trend, and it's not. It's a potential change of trend. So this line right here, this price level right here, where it crossed and stopped, that's where we have to draw our next line, because that becomes, if that gets violated, that is a new trend back down in the opposite direction, very similar to what we had here, right? But what else do we need to add to this equation? Well, we need to add what was the high prior to this low and the potential change of trend. So we have to draw the same exact thing up here. Now, one thing that I am very known for is finding the right price. So when you start to draw your lines, when you start to draw your trend lines, you need to be paying attention to what's the right price. What is the price that this particular security is actually struggling to get through? Now, most amateur technical analysts will be like, oh, it's just up here. But you look to the left and you start to see a pattern of what is the right price and what price matters. So I actually drew it here. Now, you could get, if you really want to get old school, you can put it up there. It doesn't really matter. We're in the same area. The real most important part of what we're talking about is that during this sell-off here, which was the June 10th FOMC announcement, which we're kind of experiencing something like that now, the market kind of went into a stupor for the better part of 4 to 5 weeks until we finally got back out of here. But here's the point that I want to make. When the market is stuck in this box, the bias is very unclear, because you had a potential change of trend, you had a previous high, and everything in between there is the right price for right now. So it's very simple to do, and the key to doing this, and the reason I do it this way, is when you just use moving averages and you rely on the software to do everything for you, you're not getting a feel for the charts. You're not actually making a mental note, what's the high, what's the real price, what do we have to get through? This is an easier way to do it, and in my opinion, in my experience at this point, this is the right way to do it first. If you want to add moving averages and all that stuff later, 100%, but get a feel for the charts, get a feel for the highs, the lows, look a little deeper. How kind of consistency was there to how many days in a row did it close higher? Did it trade long? Did it trade short? Did it trade green? Did it trade red? You kind of don't notice those things when you're using moving averages, because it's kind of a lazy way to, like, yeah, I want to be long because it's above the moving averages. You're not getting a feel for what you're trading. So anyway, the trade of the year is when the SPY finally resolved itself after weeks and weeks and weeks of being stuck in this box, after it broke from the recent high, punched through. Now, this was not actually the trade. This was the trade of the year and the gift that we had from the end of July into pretty much the end of August. So basically the entire month of August, where price finally got out of the box, pulled back, held the level that was significant, and then that was the signal to be long, and be long in a smart way for basically the entire month of August. Now, what's going on with a lot of traders right now is they're not recognizing the fact that the market's in a box again, and they're fighting price action. So if we draw this out and go out to a little bit longer term, so we did exactly the same thing. We started at the lowest low, went up through the lowest high, excuse me, the first price action prior to the high. Now we're in a box again. And this is where a lot of traders are getting caught. They're not recognizing the fact that it's a monster box because of the sell-off that we had here, but we're still in a box. So that means right now, based on what the market's doing, we're waiting to determine, is this a change of trend, or do the bulls come back in and give us something to write about, something to trade with a little more conviction? So what does that mean? What is the minimum criteria that we could be looking for a new trade? Well, at the very least, we're looking for this. We're looking for what we call well bid and closing on the highs for consecutive days. And you can see we haven't seen that at all. We had it once here, but anything but, oh my gosh, that was a giant green candle. It was green, but certainly not, oh, let's go, you know, that kind of thing. So yesterday we actually had a little bit of hope from the bullish side, where we actually bounced off the lows. It was just an end of day move, nothing really significant. So what we'd be looking for today, and what you would be looking for in all of your individual stocks, would be a big green candle with higher highs and higher lows. And the more consistency we see with that, like this here, the greater conviction we can start to dip our toes back in with the wind behind our back from the market. Now, taking Apple into the same consideration, Apple did virtually the same thing, where it went parabolic off the lows. And this was the trend line, right? This was the June, the June meeting was over here. So Apple did not actually sell off with the June 10th meeting, but it did break the trend line here, right? This is just ahead of earnings. So it broke the trend line. And if we stick with this same philosophy of drawing these lines, right? And we're really looking for price. We're looking for the right price. This is where Apple was stuck, right? So it got stuck here, but it was only stuck for a couple of days. Earnings came out, and then we had that same move. And look, not coincidentally, it was that same time that the market found amazing support after breaking out of its box. So Apple and the market broke out at the same time. Now, here's where traders are getting in trouble. They're not recognizing the fact that Apple, they're just seeing Apple. They're just seeing Apple that was at $500 and not recognizing the fact that the stock is stuck. And if you could just go back just about a minute and see what I just mentioned about what we're looking to see in the market, not only are most of these candles red, which means it closed below the open and sellers have been in control of the stock from day to day, none of them are large green candles. The last large green candle that we had is all the way over here on August 21st, which at this time is almost a month ago. So I know this is split adjusted. That doesn't make a difference. We're still looking at the same stock. We're still looking at price action, right? So if you're trading Apple aggressively right now, you're missing the picture. It's stuck in a box in a change of trend, and it's a really, really wide box. Now, if you want, and using the longer term picture, you could be using this box because it's a little bit more defined, right? But regardless of whether you're using this box or the actual change of trend box, which I could see getting away with this one, right? It's still in a box. So if you're trading aggressively right now in a stock that's stuck in the middle of nowhere, you're probably saying, I can't trade this market. You're probably saying, I don't know how to trade. You're probably saying, every time I put on a trade, it moves against me, because you're in the wrong stock right now. Think about that. We have so many other stocks like Penn, Workhorse, Micron yesterday had some really good moves off the lows and actually has had a nice 5-day run. Don't trade Apple just because it's Apple. Trade Apple when it's a great opportunity. When you learn how to look at the market, look at the sectors, break these sectors down to industries, and then you learn to build your own list, that's where trading becomes fun, and you don't doubt your ability because you're in the right stocks. If you're watching this video right now, I'm pretty sure that you have a burning desire to succeed. It just takes a little bit more to organize your thoughts and be in the right trades. It's very common, like I mentioned it earlier in the video, to be trading the same stocks over and over again, but make sure you listen to the whole part that I said. Apple might be in my list right now, but that doesn't mean I'm trading it. And this is what separates somebody who's a struggling chart reader from somebody who makes the leap to tape reader, who makes the leap to paid trader, because you're in the right stocks, because you should be. So work the charts a little bit like this. I think you'll find a revelation where you've maybe been making some trades in a stock that you had no reason to be in other than it's a stock that you know. So leave a comment below if you have any feedback on this and if you tried it, and especially let me know if you tried it and it became a successful idea for you, or if it just lit up and you're like, oh my gosh, I can't believe what I was doing. And definitely join me in the boot camp. It's such a tiny investment for what you get out of it for 30 days. I'd love to see you on the other side. Have a great day, everybody.